interesting moves coming through in the market. Nitin Bhasin is head of institutional equities at Ambit. He's back on the program with us. Nitin, thanks very much for joining us. So this is a bit of a slow burn, right? No big directional moves lasting, but behind the surface, maybe there is some positivity building, and you kind of sort of, once the lid comes off and things explode higher, that's the charitable way to look at things. The other way, of course, is that nothing seems to be sticking very much. And we've had a bunch of these, at least measures from the government aimed at boosting consumption, etc. How would you look at it, and what's the view from here?
Thanks for having me here again. Over the last few months in our interactions, time and again with you and your team, we've maintained that, this last 1 year and perhaps the next 6 months also, the market is not going to be any different from what we have seen till now. Again, very similar to this grinding market where we still continue to prefer large caps over mid caps and small cap. The economic trends, the earnings trends, and we can go deeper into those. They seem to not give you that confidence that, a particular bunch of sectors will have a material earnings growth. And hence, a stock picker market, a large cap preferred market, all of these measures by the government perhaps only supporting the mood, not accelerating the Indian economy or the earnings growth, I would say.
So 6 months range bound, 6 months more of time correction. Nitin, that's the view.
You can see for yourself, for the last 1 year, Nifty has been pretty much there only. And for the last 1 year, large caps may have delivered a returns of closer to about, let's say, the top 100 stocks, closer to about a few percentage points of positive. Whereas in the last 3 months also, large caps could be positive, but the mid caps and the small caps, no returns to speak of, perhaps would have marginally lost money. So I would say focus more on finding good quality companies, finding companies where valuations are in your favor, and earning estimates look up, because at the larger level, Nifty earnings growth is just 6% for this year in FY26. FY26 is only about 6%. Where do you go out and take a very directional view? So that's my call for our investors. But within that, we can always choose sectors.
Okay. Could you, Nitin, hi, welcome to the show. If you could just narrow down on these sectors that you might be looking at, which do have that earning potential.
I think market, because it has become a very much flow-dependent market, and what we highlight is that if you look at the domestic buying and the FI selling, $54-55 billion came into the markets over the last, let's say, 12 months. Money moves into rotation where there is earnings, where there is lack of earnings. So our call has been, which we've indicated before also, we prefer IT over banks, IT being a contra call. Banks, perhaps we are getting into a little bit of a moderation situation in terms of earnings estimates, revisions, etc. And perhaps also, you never know how the tariff has a quasi effect on the jobs sector, such as gems and jewelry or textiles. Could it become a risk tomorrow? So we would prefer IT, contra view. A lot of earnings cuts are behind us. Perhaps we get into this year, make money over there. That's number one. Number two is FMCG. We've been highlighting again for the last few months, 2 or 3 months now, that rural inflation has been coming off, a reasonably decent monsoon, and now with all the GST cuts, perhaps it helps the more F&B based food and beverage companies, or at the value or the FMCG side of it. So we prefer that. And lastly, it would be healthcare / pharma, healthcare followed by pharma. I think those are the 3 sectors that we have been indicating: IT overweight, FMCG followed by pharma.
Okay, all right. Hi, Nitin. Good to see you. Nitin, all through 2025, we have been talking about the FI positioning at extreme levels. But they're not letting go, right? They continue to sell in the cash market. Lowest in the last 13 years, I think so, in terms of percentage holdings in the cash market. And the short positioning is at the highest, I think, ever, at around 93%. If you look at it in percentage terms. In absolute terms, maybe it got around 5-6%, more to go. What's your take now? There's only so much you can sell, right?
Yeah, I think we've highlighted about this indicator in the past also. This is sort of a contra indicator. When you have such high short positions, it becomes more like a contra position for the near term bounce. But we see that time and again, the market is neither giving up the ground of 24,500, nor it is gaining anything beyond 25,000 and a few hundred points here and there. So hence, I would say read into this. But the last fortnight, what we have also noticed is they're becoming positive buyers in cash market on auto, in chemicals, and selling a lot of IT and banks. I think FIs also are perhaps trying to figure out where there is a more near-term momentum or where the trends are changing. Perhaps GST led for them to get into the auto companies. So yes, you're right, they can't sell more, but grindingly, they've been selling over the last 12 months. And India remains relatively an expensive market across to the other global markets. So I think this remains for the next 6 months.
What's your sense, Nitin, in terms of how they're approaching consumption?
So in the terms of consumption, me and my team believe that in the near term, at least for the next 6 months or so, the trends appear like the value retail format, the value consumption format from especially rural parts of the world. Within that, you've got food and beverages over HPC, which is personal consumption. I would say those were the trends that could actually stand out. More value, rural, and food and beverage, those sort of things. Premium has held up well in the past. Ultra premium, I'm not doubting that, because we don't see a lot of pain over there either from markets or otherwise. So the ultra premium consumption will stand, but urban consumption, urban mid consumption, urban low consumption should remain under pressure. It's more about, as I mentioned earlier, rural value formats, and within that, food and beverage.
Nitin, we'll leave it there. Good conversation. Thank you very much for joining us here on CNBC TV18. We'll take a quick commercial break here with news.